With interest rates still adjusting and inventory shifting and affordability on everyone's mind, is buying in 2025 the move or is waiting smarter? Guys, welcome back to another episode of Closing the Deal. I am your host, Sam Enright, and today we are talking about buying in 2025 or should you wait? Sitting across from me is my co-host, Zach Dickson. Zach, what is going on today, brother? How are you?
Oh, fantastic. Cannot complain. Another beautiful day and super excited for our podcast episode today. Should you buy or wait here in 2025?
Absolutely. Feels like obviously a prevalent topic. I'm sure could do an episode of this every single year when it comes to, people. That's always the question at hand. Should I buy this year or should I wait? What are the factors that go into that? What are things to take into consideration? And hopefully we put together a pretty good episode today, not only just of our opinions and things that we see in the market, but also of some facts and some statistics and things to help you guys, maybe kind of navigate that decision. Ultimately, we're going to talk about it, but it is, up to you, the person, and what your goals are. But, obviously throw a little bit of numbers in there for you guys to, kind of help make sense of what's going on out there and things to expect.
Yeah, I think we have a pretty good episode put together today. I think it's a question that's very prevalent every single year because of a major fact that I think we've touched on a lot in our content and podcast as a whole is that this is usually the biggest financial decision, financial purchase that you make in your entire life. At that point, I should say, at that point, usually you start to buy bigger homes and more expensive homes as you age, but at that point usually going to be the largest financial purchase that you make at that time. So it's always going to be a very difficult decision, I would say. So obviously, with it being one of the biggest financial purchases that you make in your lifetime, it's going to come with a little bit of doubt, second guessing, all of those things, and especially when you throw in economic factors as well that are sometimes negative, sometimes positive. I would say in this instance in our market right now, we are seeing some negative economic factors that are probably driving that thought towards the wait side, as we'll get into a little bit in the episode as a whole. But yeah, I would say just as a whole, this is a very applicable episode for each year, not just 2025, just because, again, it is a very, very large purchase.
Yeah, for sure. And I think ultimately the reason it is so prevalent year over year is because, ultimately we've talked about this before in one of our beginning episodes, but just the idea of buying and how that, I guess it's sold to us as the American dream, right? When we're coming up through school, when we're learning, when we're going through, the things that we do in life, it's almost as if we're taught, you go to school, you get an education, you either go to college or you go directly into the workforce and you save money, you invest, you buy a home for your family, you start a family, whatever the case may be. And that's kind of the road map that you follow. And so when those things are, taught to us, that becomes a prevalent thought on our brains, what can I do to buy? Should I wait? Is this something that we should take on? And so, it's something that I feel a lot of people kind of go through and have questions about. So, hopefully we can kind of help answer, what the market looks like this year, if it's a right time for you. And, maybe some of these things speak to you as a person and you guys decide it's the right time. And some things speak to you and you say, whoa, this is not the right time for me, and I think that's what makes it kind of interesting is, yeah, there's specific numbers that kind of break that down, but ultimately it boils down to you, the individual, right? And where you're at in your life, what things are going on, and kind of breaking it down from there. So.
Yeah, because somebody's ready is going to be another person's not ready in any instance, in life and in different situations. So just got to look at it from your own individual lens and not necessarily a generally speaking lens, and make sure that you're looking at it with your specifics and your situation as a whole.
Yeah. Yeah, absolutely. I mean, I can obviously tell from my own, for my own personal, is 2025 the right time for me to buy? I'm planning a wedding next year. So, there's a lot of expenses and things that are going out that, trying to couple a down payment and these things on top of that is just, it's not something I want to put on my stress levels right now. But, obviously, it has nothing for me personally. It's nothing to do market related or anything like that. But everybody's a little different. Some people are going to be highly focused on market. Other people are going to be highly focused on personal things that are going on in their life. Is this something that makes sense for me due to expenses or things that are coming up? And other people are maybe a mix of both. Maybe they have personal things going on and they're concerned with the market. So, obviously, I think that kind of segues us into our first topic here, our first segment, which is what is going on with the market in 2025. And what are kind of the biggest questions that most people have? I think, ultimately, when I think of at least two of them, it's always going to be, well, what are home prices doing? And what are interest rates doing? Obviously, a lot of people are financing in order to purchase a home. And so they're really concerned with how much it's costing them to borrow the money to purchase this home and what kind of payments are they going to be looking at and that sort of thing. So, um, as we kind of get into it, obviously we're I guess a little bit more than halfway through 2025 at this point. So, as for interest rates, I guess we can start there. Just kind of based on where the 10-year treasury is at from year to date. So January 1 down to at this point, what, August 20th that we're recording this. It's down 26 basis points. So if you guys don't know, interest rates for the for mortgages follow the 10-year treasury bond. So if you're ever curious about what interest rates are doing, you can always jump on MSNBC or Yahoo Finance and look up, what the 10 years doing on the charts. And if the 10 years up, then interest rates are going to be up. The 10 years down, interest rates are going to be down. Kind of at least an easy enough way to kind of track what's going on. Usually in the past, it's been about, you'd add about 2 points to whatever that's at, and that would kind of track with where rates are at. We're a little bit above that from where we've been kind of ever since coming out of COVID. What that means is, like, so right now the 10 years at 4 as of last night when the market closed, I believe is at 4.3. If you were to add 2 points to that, which it's a little bit more, that's where you would normally kind of see rates be at. So right now we're kind of, I would say, right around 6.5. So it's a little bit higher than just adding 2 points. But obviously, as you can see, we are trending downwards from the beginning of this year. We have seen some ebbs and flows, and so we've had them a little bit higher, we've had them a little bit lower, but as of right now, we're a little bit down. Now, home prices. So according to Zillow, and I will say we will link all of this stuff in the YouTube description. We can actually, I think we can do it on, can we do it on the regular podcast description as well? Okay. Yeah. So
Indeed,
we'll link all
absolutely.
this stuff. Cause I obviously, pulled all this data, and you guys can feel free to go look at it yourself. But according to Zillow, home prices have risen 0.3% year to date so far across the U.S. for an average home price of $368,000. Again, that is on average across the United States, so not necessarily specific to here in Central Ohio or Ohio in general. But just to give you guys a little bit of an insight, obviously we're roughly right around where we were last year. 0.3% is obviously not that huge of a jump, in my opinion. And then inventory, another one that is a good statistic to kind of look at, where are we at with inventory year over year? Do we have more houses on the market? Do we have less houses on the market? And according to Y Charts, existing home inventory in the US is at 1.53 million, which is up from June of 2025, which they were 1.34 million. Or June of 2024, my apologies, up from June of 2024. So we had about 200,000 existing homes out there in the inventory, year over year. So, what does that mean for you, Zach? I mean, what is some kind of takeaways that you have from those statistics, and kind of, your overall thoughts of, the market as it stands here in 2025?
Yeah, so just kind of picking back off of what you mentioned there about price and interest rate, I think you're absolutely right with the notion that buyers are going to look at those two numbers first and foremost as a whole when they're looking at their market and whatnot. But I'm really stuck on that inventory number as a whole, to be honest with you, because we live in a capitalistic society, obviously, and so that means that prices are going to be determined by supply and demand, and obviously our inventory is going to be our supply, and so that's one aspect of that conversation to get to the price, which we talked about is going to be a big factor in the buyer's eyes. If we have more supply than we have demand, then prices are going to lower and those are going to be more affordable for those home buyers. Now, if we have more demand than supply, obviously it's going to be the inverse. And so we're going to see prices rising and become a little bit more unaffordable compared to what they have been. And so I guess when I see inventory start to climb up, we're not seeing the other side of things on the demand side and seeing, how many home buyers there are actually out there. I would venture to say if we did the number that we still do have more buyers than homes on the market at this time. So we do still have more demand than supply. And so then at that point, prices are going to continue to rise in some areas.
Yeah, I think ultimately you hit the nail on the head with the inventory. I think obviously that's extremely important numbers to look at. Obviously just kind of looking at the data as a whole. I mean, yes, we're down 26 basis points year over year, or not year begin from the beginning of this year. When it comes to the 10-year treasury. However, we're still basically on pace with where we've been. We'll link another one that I use for other data, but with mortgage rates, with where they've been on average for the last several years, looking from 2022 to 2023, 2024, we're right on pace with where we've been in 2023 and 2024. I think they were a little bit higher at about 6.9%. I think on average this year, we've been at about 6.88. So again, we haven't seen rates do a complete flip or anything like that. They're still relatively where they've been the last several years. And home prices, again, 0.3% year over year, is not a massive amount. And so, the market is very much, in my opinion, kind of in the same spot. I mean, there is a little bit more inventory obviously out there, but, from the interest rate perspective, from the home price perspective, we're looking, basically kind of the same that we've seen in 2024, in my opinion.
Yeah, great info for sure. What's I think one just quick question clarification for the buyers. What would a 26 basis point change do to a payment? I know we're going to get into some examples later on in the episode, but just quickly, what would a 26 basis point change do?
Well, I mean, ultimately, like I said, I mean, the 10-year, while we do follow the 10-year, mortgage interest rates do follow the 10-year. It's not exactly perfect science to say if it drops from this to this is where rates are going to be. Obviously, investors are still going to mark their rates based on, on that data. However, I mean, let's say we started the year at, at an FHA being at, ultimately, let's say it was high sixes, right? 6.875%. I would say FHA right about now, we're probably looking closer to mid sixes, mid to low 6.5, 6.375. When you're talking about a 0.5%, I mean, ultimately, how much does it affect your payment? We're talking how large is your loan size? I mean, that's going to be a huge factor as well. Is, obviously the more money you're borrowing, the larger change in what that payment is going to be. However, you would be surprised. I mean, we looked at one for a client the other day, and it's just funny. Like the interest rates when you're talking about like halves and quarters, it would not affect it as much as you would think. Honestly, I don't necessarily know without knowing the true numbers of the property, like how much we're genuinely looking at. Obviously if you're borrowing $75,000 to buy a house, your payment's probably going to be impacted by 20, $30. You're buying $500,000 worth of house. Now you're obviously talking much difference, in payment there. You're talking maybe, 100, 150, 175, getting that 0.5% difference, in interest rate.
And I guess that's where I was getting at, honestly, is buyers are obviously paying attention to these rates and how they move and whatnot. But ultimately, for them to move like substantially and significantly to affect your payment, very significantly, we'd have to have like a black swan event, like to completely like a COVID or a market meltdown, something like that, to really just completely change your payment. Half a point, quarter of a point, that stuff's not really going to change your payment very drastically. So if you're holding off, buying in the hopes of it changing, a quarter point, half point, then may not be worth it. But again, like I mentioned earlier, we're going to be talking about some examples later on in the episode. So
Yeah, for sure. I mean, when you start talking about like an entire percentage point or a percentage point and a half, now we're obviously talking bigger differences in your payment, than what it would be. And so obviously, yeah, we'll get into examples and those sort of things, just kind of looking at, where things have trended. Obviously we'll pull some data from the past. Not like COVID past, because obviously I don't think that those are it's a very good representation of where the market could potentially go. But, I think ultimately, if we look at, what was pre-COVID slash right after post-COVID, I think that's more in alignment with where, I guess the few years prior to COVID we were as a market. We can definitely look at what those cases would look like. So, but kind of going into the next section here, cases for buying in 2025. What would you say to prospective buyers or people that are looking to kind of get out there in the market, maybe put offers in on property? What would you say to those people, would be a good idea or a good reason to buy in 2025 based on kind of the data that we're obviously looking at here?
this is something that we've talked about so many times and is always going to be prevalent, not just in 2025, but always when purchasing real estate. It is building equity. So when you get in to when you buy a property at your purchase price, generally speaking, you're going to be able to sell that asset sometime down the road for more than what you paid for it. Obviously, that's the general rule of thumb. That's what we're looking for when we purchase real estate, and ideally that is what happens. Now in certain aspects, certain economic conditions, that may not necessarily happen, or if you're trying to turn it around very quickly in a 1 to 3 year time span. But generally speaking, when we purchase the property, we're going to be building equity just by owning it and holding on to it for years on years. And so that's going to be the number one proponent that I always have for buying property, no matter what the rate is, no matter what the prices are. Ultimately, when you are buying property, you're looking to gain appreciation and build equity. And so ultimately, there's just not really another asset class that you can feel that comfortable with on a risk scale that does perform year over year, decade over decade, 50 years over 50 years. It's real estate. Stocks and things like that are available for us, but obviously real estate is the safest, most advancing asset class there is, in my opinion. And so buying property, you're able to start building equity right away. And having access to that equity just opens up a lot of different doors for you as a whole, as a homeowner. You can use that money to rehab the property. You can use that money to take a dream vacation. You can use that money to do whatever you want with it. It's your money completely. And so I think that's just my biggest proponent of buying a house as soon as you possibly are ready. And so to be able to start building that equity right away.
Yeah, I think ultimately, that is obviously the largest component as well. When looking at buying in the case for buying, it's almost as if, we talk about it getting in, or, I guess maybe we don't talk about it, but we've been told or, been coached over the years that obviously getting into investments at an early age to allow that, compounding interest over time. And I think, real estate follows kind of the same guidelines of, the quicker that you get into a property, the quicker that you pay that mortgage down, the more equity that you build, not only with paying, the mortgage down. When you owe less on a property, obviously you're going to have more equity. On top of that, the appreciation level of real estate as it goes up in value, and you're also paying that loan off, you're continuing to build equity as well. And like Zach said, having access to equity can open a lot of doors just for different things. If you are wanting to take a leap and start a business, you could potentially tap into that instead of having to go out and ask people to invest. In the business for you or with you or whatever the case may be. You could fund it yourself. There's all types of different things that can be used for. And I think that it is, again, one of the largest. I don't think that that's going to change. If you ask us in 2026, you ask us in 2027, you ask us anytime here in the future, unless, something catastrophic were to happen and, suddenly home values decrease, majorly, again, the average national appreciation for homes is somewhere between 3 to 6% on average. So, that's money that, again, is continuing to build while you continue to pay down. So, and then obviously, like, if rates are a concern for you, this is something we talked about in the one episode where Zach and I, had talked about, the difference in differentiating advice and things that we felt was bad advice. And, there was something that got brought up about, marry the house, date the rate. And, our opinions on that. And I think ultimately, there is I think that from the most part comes from a good place when it comes from lenders. We talk with a lot of clients who I think fall in love with these properties. They fall in love with the idea of buying a home, owning something themselves, doing what we're talking about, which is, building equity, those sort of things. And then they get caught up on this interest rate thing. And then we sit here and we talk about, well, what could potentially happen? And it's like, well, if rates do indeed fall, if you're so concerned, if you can afford the payment, you love the house, but you're concerned with where rates are at, but you can afford it right now. And if rates fall in, let's say, 2 years, like you predict, if you don't wait, right, and you buy the house now, what happens in 2 years? That house is likely now worth more value, and you could go back in and refinance for a cheaper payment based on what you owe, which is not what you would have paid in let's say 2027 to buy the house. So now, you have a lower interest rate because you got to refinance, and you got the house for likely a lower price considering the fact that you bought it 2 years ago and it is appreciated in value in that time period. On the other side of it, let's say interest rates go higher and you can't refinance. Well, if you were to wait 2 years and interest rates were to go higher and you try to buy a house then, well, not only has the home appreciated in value and now it's worth more, but also it's going to cost to borrow the money to buy it because interest rates have gone up. And so, the only time I think that you're obviously, I would never recommend anybody strap themselves to buy a house. I would never say go out to your max budget and put yourself in a position where that's all you can do. But if you're on the fence about buying and you're concerned with rates, but you are comfortably affording the payment, for me, I don't think that rate is the end all be all, in my opinion. Just because, you never know what's going to happen with the market. If it goes down, you have the ability to refinance, as long as obviously you keep your finances in a good position, you keep your credit in good position. And if they go up, then you basically beat the market, and now you've gotten a property in and you've gotten locked in at this rate, and you don't have to worry about rates going to 8%, 9% if that were to happen. You know what I mean? And so, and obviously during that entire time you're building equity. So that would be my case for buying in 2025. Again, it's not, it is largely dependent on who you are as a person, what goals you have in mind, things that are going on in your life, and whether or not it's feasible. Obviously, again, I will never tell somebody to go stretch their budget, completely drain their savings or anything like that to buy a house. But if it's something that you've been thinking about, it's something you're on the fence about, and your factors are interest rate or home prices, hopefully this will be an episode to kind of show you that, hey, those are, while they are concerns, I don't think they're the biggest concerns when it comes to buying a house personally.
Couldn't agree more and couldn't have said it better myself, brother. So on that note, I will transfer us over to the case for waiting and the case, kind of the negative side of things here in 2025. As a whole, I would say that, I would definitely agree that there are affordability issues in our housing market at this time. There's no question about that, whether that's on the buy or rent side. It has become, I mean, even if you just look back 10 years and look at a property that sold 10 years ago compared to what its, current market value is now, it's very drastically different. And so those payments obviously change as well based on those purchase prices and loan amounts and whatnot. And so it can be very much more expensive than what it was, 10, 20, 30, or even 50 years ago when our parents and grandparents were buying properties for, pennies on the dollar. But as a whole, it, it goes back to what we just talked about in the previous aspect of, if we get in at this, if we got in 10 years ago at 2015, we'd be looking at this with $100,000 of equity in our pocket too. And so while I understand that, and while I understand that issue, it may be something to think about when you decide whether we're buying or waiting as a whole.
Yeah, I mean, ultimately, you're right. Let's be real. There is obviously affordability issues. We see it every day in this business. We see homes that are worth such and such amount that, 5, 10 years ago were worth way less than that. I mean, I think that's pretty standard across the board, just as we look at life in general. If we look at groceries, we look at gas, we look at all of the I mean, we're big golfers. If we look at golf, I mean, if we look at all of these different things that have gone on in our market, everything over the course of the last several years has gone up in price. That's just reality. And, whether or not wages for you specifically have gone up in that time, I don't know. And so obviously there could be some issues there when you're not making more money and everything costs more. That's obviously a big issue. And so I think there's multiple reasons for a case for waiting. I think if you have things going on in your personal life, again, I'm a very calculated person. I like to take a step back and think about things. And so, when I think about money, I think about, long-term effects. I do believe that at some point, you do got to kind of step out and take a risk because, we were just talking about it with my dad last week, right? When we were, at the Board of Realtors golf outing. It's just like, he said, you're never going to be ready to buy a house. You're never going to be 100% ready to have kids. You're never going to be 100% ready to start that business. You're never going to be 100% ready for a lot of these things in life because that's just life. Life doesn't allow you to get fully prepared for something. It basically kind of thrusts you into it if you want to do it, and you kind of have to learn and figure it out as you go. And so, if that's not something that makes sense for you right now, I totally get it. Like I said, I'm in that same boat. I'm gonna wait. Again, my factors are not necessarily economic as much. Well, I guess they are kind of economic because everything costs a freaking boatload. And so like the things that we have expenses on are much much are a lot higher than maybe anticipated. So I would say that's a case for waiting. I mean, as for, the other things, a lot of people are going to ask us, well, what if home prices fall, in the next 3 years? Or what if interest rates, fall out of the sky in the next 3 years? Could that happen? Certainly. Will it happen? I don't know. I'm no Nostradamus. I cannot predict the future. So, if I was a betting man, would I say that somehow we're just going to fall back down to 4% interest rates and homes are just magically going to become affordable? No, I would say that that's not reality, in my opinion. So I think ultimately, if that's the reason that you're waiting, I would disagree on that, and because obviously, like Zach mentioned, we would need a catastrophic event, correct? We would need something that would have to blow the economy up in a way that just, but think about it. If you're on the fence now and we have, and the economy is doing better, right? Based on these numbers, you would say the economy's in a good place. People are earning wages. That's the reason they can pay for these houses. That's the reason that, usually when interest rates are high is because people are spending a lot of money. And then if they're not spending a lot of money, then they come in and they try to cut it to get people to spend. And so, if that's the case, if it is going to take an economic catastrophe for that to happen, what do you think? Do you think you're going to be prepared when the economic catastrophe happens, or do you think you're going to be trying to stay afloat? You know what I mean? And so that's something to think about too, is like, a lot of people are going to sit and say, well, maybe waiting's the best call because when rates and all these things drop, and it's like, well, what's going to happen to the job market? What's going to happen to the economy as a whole if this catastrophic event, happens? Are you going to be prepared? Some of you might, yes. If you have been preparing for this, then yeah, maybe if you're one of those people that's just like, yeah, I'm going to sit on this until that time comes, then to each his own, absolutely. But it's just one of those things. I think it's something to think about when it comes to necessarily thinking that prices are going to fall out of the sky and all of a sudden everything's going to become affordable again. I just don't know that that's a reality in a world that we live in.
Couldn't agree more. I couldn't agree more. And it's hard. I would say it's hard human being nature wise, like to look at a property on the market in 2025 and like look back 10 years ago what it was listed at or what it sold at 10 years ago and not like have like a kind of buyer's remorse, I would say, or like just you wish you could be 10 years ago. Like it's hard to wrap your head around, purchasing this house for this price when you know it 10 years ago it sold for 100K less or whatever it may be. It's just hard to convince yourself that that's a good idea, that it's a good investment, that it's a good choice as a whole. And so I understand where it comes from on the price side of things for sure. I definitely understand. And like my boy Warren Buffett said, you got to be fearful when others are greedy, and be greedy when others are fearful. So if we did have that catastrophic event, it's time to at that point to be greedy for sure.
Yeah, for sure. And I mean, ultimately, again, if that is what you are banking on, then by all means, if you got 10, 20, 30, 40, 50, 60,000 stacked back and you're like, I'm waiting for this event because when COVID happened, the guys who got it all were the guys who were prepared for such an event. But, ultimately I'm not trying to take a shot or anything, but we're talking about, who was affected the most. And most average Americans would tell you that they were not on the side of, okay, I'm ready to just go out and purchase a house and go buy 10 investment properties because COVID knocked down the prices and knocked down interest rates. That's not most people's reality. And so, if you're listening to this and you're more so in that boat of like, hey, that's not probably my reality, or if you're in the boat of like, yeah, I'm a big investor and I'm going to set back money and, I have a feeling that this is going to happen, I guess, to each his own. So again, everybody is different. Everybody falls into a different category, and it's all about, how you interpret it yourself. Ultimately, we're just trying to, I think, just show the data of where things are at, where they have been, and try to project where they're going based on that. But nobody truly knows. I mean, obviously, prior to COVID, nobody knew that mortgage rates could ever even get that low. We'd never seen anything like it ever. Like, you know what I mean? And then you couple that with looking at what these home prices were at the time, like just insane what was going on back then. But we've been there now. And so to think that we're going to go back there again, I just don't know that we're ever going to see anything quite like that again in our lifetime, but could be wrong.
We shall see. We shall see. Got some time left for sure.
100%. Well, guys, wanted to get into kind of a case studies, as you will, segment here. I did pull some data for you guys. I just kind of wanted to show what these properties look like in 2022, because I feel like going back earlier than 2022 would be an injustice to these numbers. Obviously, if I pull 2020 and 2021 numbers when interest rates are at 3%, like that's just not going to give you an accurate depiction of where things realistically could go in the future again. Because I'm of the belief that, we may only see that event one time in our lifetime. So, I went for something a little bit more conservative, just back down to what the average interest rate was in 2022. And again, we will link that down below so you guys can see that. But the average interest rate in 2022 was 5.5%. So we're about 1.3% off from where we are today. And I wanted to show you guys based on what appreciation has done, what interest rates have done, what these house payments were back then versus what they are now, and home values based on that as well. So Zach pulled some data for me on a property on Wintermute in Newark, Ohio. This property in 2022 sold for $152,000. The average interest rate, as I mentioned, in 2022 was 5.53%. So principal and interest based on a 30-year loan term, and I did do just a regular FHA mortgage with 3.5% down. That P&I would be $835 a month if you would purchase this property at this time back in 2022. Fast forward 2025, this property just sold again. The sale in 2025 was for $224,900, and the average interest rate as of this year was 6.88%. Principal and interest, again, based on the same terms, 30-year term, FHA, 3.5% down, was $1,426 a month if you just purchased this property in 2025. So digging into those numbers a little bit, that is a difference of $72,900 in value from 2022 to 2025. Now, I think Zach and I would both admit that amount of appreciation, while also admitting that we likely will not see the way that the COVID rates went. I don't know that we'll see that level of appreciation 3 year, over that time period. I mean, that's a pretty huge amount. In my opinion, I don't know what the actual math broken down on that is. Can we do that real quick? Do you have it?
Quick math. It's like
It's got to be on the
50%.
higher end.
Yeah, 40%.
Yeah. So
100% would be 304. So
yeah. So there you go. Obviously, we're talking about, as we talked about, national average year over year. Again, an average over, you know, the time span here is 3 to 5%. So to expect that kind of growth again, obviously, that's not something I'm going to bake into our numbers here. But again, just to show you where, if you were on the fence in 2022, what would have happened for you if had you bought and not waited? Because I know, again, in that time period when rates are coming out of this 3% range, this 2% range after COVID, I know a lot of people, I was working in the business still back then, a lot of people, well, let's wait. Let's see what happens with the interest rates. They're up in 6% now, but they're saying they could go back down. We could get back, we could steady out around 4%, low fives. And then, all of a sudden, here we are 3 years later and we're at basically 7%. You know what I mean? So, and the difference in principal and interest payment over that time period as well is $593. So it would cost you $593 extra dollars a month and cost you an extra $72,900 to purchase that same exact property 3 years later. So now I did run some numbers for the potential appreciation, and I went on the low side. I did do it. Actually, it says 3%, but I did it at 4%, just kind of met what I guess assumed right in the middle there. So potential appreciation at 4% per year, that would make that property worth $245,754 in 2028. So same 3 year period at 4% appreciation. And then that payment, if rates were to maintain in 3 years, so if we're still at 6.88%, that would be a $1,558 a month payment. So again, we have gone up another $125 based on just the appreciation, and then payments if the rate were to go back down to 2022 average. So for anybody out there that's banking on rates going down in the next 3 years, if we somehow steady back out to that five, around 5.5, you'd be looking at $1,350 a month payment, which is about $76 difference than what you would pay right now with 6.88%. That's based on the appreciation. So initial look at those numbers is to say, to save $76 a month on banking that the rates go back down, would it be worth it? I don't know. That's up for you. That's for you to decide. But ultimately, if you were to be one of those people that says, I'm banking on rates going back down, I'm not really banking on house prices to change. I think they're going to be, be on their their average appreciation amount. We're going to be here. Your payment's changing $76 a month by waiting. 76. So wait 3 years to save $76 a month. Again, that's up to you if you feel that that's worth it. Any thoughts on that numbers there before we kind of dig into a different housing area?
yeah, just the savings between 2022 and 2025 is crazy. Honestly, it's almost $600 a month. About $7,000 a year just back into your pocket solely by not waiting. It's just crazy.
Yeah.
If you were in that instance, if we were having this episode right now in 2022 and you decided to do that, you would have, gained about $75,000 in equity on this property and saved yourself about $7,000 in cash flow every single year. So you do the math on that one. Just by holding a property for 3 years, a little bit crazy. So,
yep, absolutely. Yeah, and I mean, obviously, some of this stuff is based on when you get in and
for sure.
obviously what's going on. So, again, I don't think that thinking that, that's why I didn't base the appreciation numbers. Oh, that property is going to be worth 320 grand in 2028. You know what I mean? So even at the higher, I mean, the one that kind of blew my mind, I guess maybe not blew my mind, but just made me kind of realize was the one, if the rates were to drop, right? But you still have the appreciation, you still have that home being worth more in 3 years. What does that really do? How much money are you actually going to save? You know what I mean? And as we talked about, I mean, we're talking the difference between 2022 to 2025 was you would have saved almost $600 a month. Now we're talking the difference between 2025 and 2028 if the rates were to drop based on, unless again house prices fall out of the sky, you're only saving $76 a month. So it's like, does waiting pay off? Are you willing to bet that the market is going to tank in the interest rate department? I don't know.
So moving on to our next property, it's going to be on North Star Road in Columbus, Ohio, on the edge of Grandview and Upper Arlington, Columbus area. So this property sold in 2022 for $436,000. Again, our average interest rate in 2022 was 5.53%. And so a P&I in 2022 on that property, based on the 30-year term, would be about $23.97 per month. And so again, this property did resell again here in 2025, and it did sell for $495,000, which was a difference in home price of about 59 grand over those 3 years. So the average interest rate, again, like we talked about in 2025 here, is 6.88. And so that P&I here in 2025 on that new property of the purchase price of 495 would be 31.39 per month, and a difference in P&I of 742 per month. $742 per month solely by not waiting. And so if we take our, our potential values, that's our 4% appreciation rates. Again, I think this one's a little bit more manageable on the appreciation side. I know it's still a large jump. 59 grand is a very big jump, but it is a larger purchase price type home. And so a little bit more kind of in line with what we normally see on the appreciation front. Still a little high, I would say, but a little bit more in line than the first property that we talked about. So if we do have that 4% appreciation rate per year, we're going to get to a market value in 2028 of $556,807. And so payment at that point, if rates maintain at 6.88, is $35.31. And if they go back to the 22 average, they would be $3,061 per month. And so in terms of this property, that 60 grand of appreciation is changing that that payment price, or that monthly payment, by almost $600 itself, not even factoring in the interest rate. And so going back to what Sam talked about on this previous property, is the $480 a month, if you decided to wait in 2028 to try and have rates drop a little bit longer, is that worth waiting? Now, in this instance, I would say it probably is worth waiting, just on the basis of it's almost $500 a month versus $76 a month. But again, that's a decision you have to make as an individual on your budget, on your terms, and in your situation as a whole. So again, just we wanted to throw this specific property in there as well for a little bit difference on purchase price and a little bit higher purchase price, and show you how that kind of changes the P&I as a whole. So obviously, a difference, a 1.25 interest rate difference is going to be significantly different on a purchase price of $500,000 versus a purchase price of $245,000. So Sam, do we think that rates will drop back to our 2022 level, or do you think that we will be staying, kind of in this 6 to 7, maybe 8% range as we, move forward over the next 3, 4, 5 years into the 2030s or so?
Yeah, so I would like to just do a quick circle back real quick. Before you go into that. One, I did just do the quick calculation on the appreciation rate on the property in Columbus, and you were right. That obviously is much more in alignment. That was based on a 4% appreciation. So that property basically appreciated 4% per year to get from 436 to 495. So that's obviously quite in line with what we already based our numbers on. So again, not saying that it's perfect math, not saying it's going to happen, but in 2028, 556 could very well be attainable at that point. And again, obviously when I had done the previous one talking about the payment difference, I was obviously showing, because you just made a good point there, payment would be $500 difference based on today's rates in 2028 at that higher price versus the rates at, at back at 2022 average. I guess I was more so showing that what you could purchase it for now with the appreciation being off of it at the current interest rate. Because ultimately, I wanted to show people that if you wait and rates stay the same, you're always going to pay more, right? Because the home is likely going to go up in value. And so if you think that by waiting for the rate to drop from where it is now, how much are you really going to save? And so when you look at Star Ave, if rates were to go back to the 2022 average, you'd be at 3,061. But that payment as of right now is $3,139 at today's value, even with the higher percent interest rate. So at that point, you're saving what, $79 a month if you were to wait and the rates were to go down? Because ultimately, if you buy it now, it's cheaper, even with the higher interest rate, I guess, was ultimately the point that I wanted to show people, because that's usually going to be their go-to, is like, well, when rates drop, the payment's going to make much more sense for me. But they don't take into account that the house is going to be likely worth more when they wait that 3 years, 2 years for the house to come down in value. And to kind of cut back into thoughts on rates, I don't believe that rates are going to just fall out of the sky. I think a lot of people think that, we talked about at the beginning of the episode, right? You said, how much is a rate going to change your payment? Well, when we're talking about halves and quarters, yes, if you have a large loan amount, it's going to have a pretty significant impact on your payment. If you have a much lower loan amount, you're not going to notice a massive difference. And so for these people that are on the fence waiting for rates, basically what that means to me is you're waiting for them to go back down to like 5%. You know what I mean? Will that happen? I don't know. Obviously evidence, or, I would say that oftentimes the market is, markets are like a pendulum, right? It's going to swing one way and then eventually it's going to swing back the other way. And right now, for the last 3 years, we've been swinging towards higher rates. Have we seen a little bit come down? Yes. I mean, last year, the national average again was 6.9. We're at 6.88. So, I mean, if you take 0.02% as we're swinging back the opposite way, then, maybe this is the sign. But all I know is I've been working in this business for the last 7 years. And I know for the last 3 years, we've talked with lots and lots of clients, and everybody's asking the same questions. Are rates going to come back down? I've heard lots of speculation. The Fed's going to cut interest rates. They're going to meet so and so many times this year, and they're gonna cut it by a quarter each time they meet, or whatever the case may be. And it's yet to happen. The Fed's held rates still, and we've seen a balancing act of being right where we have been for basically the last 3 years. Do we have a little bit of up? Are you going to have some weeks where, or maybe a month where rates are higher? Yeah, you're going to have weeks or months where rates are lower. We've had a couple of times where rates have, we've gotten close to 4 on the 10-year, or we've even, last September we got below it. It was like 3.9. But at the end of the day, here we are, and we're still looking at the same average that we looked at from 2023 until now. So in my opinion, are rates going to drop soon? I would say no. I would be preparing for this course to stay the way that it has been, in my personal opinion. And again, that's, I could throw all the data at you that I want, but at the end of the day, I think ultimately everybody's just throwing out what their opinion of the situation is, because nobody actually really knows, because there's been tons and tons of experts who study this stuff, who say that based on these economic factors, based on this, Powell's the Fed's gonna lower interest rates, and they haven't done it. So again, where does that leave us? I could sit here and spout whatever to you, but based on what I've seen, what's passing my eye test is going to tell me that we're on the same track that we've been. So if you're banking on rates falling to 5%, I'd say straddle up and give it another year, 2 years, 3 years, whatever the case may be, because I don't think it's happening. And again, I tell people this, like, what do people think is going to happen? I don't. If you believe that these guys are working together, do you think that the Fed's going to drop interest rates out of the sky, and then all these people that have 7% mortgages are going to go back to their mortgage company and then go refi, and then all these things are going to happen? Like, it's just like, I don't think people understand what would genuinely happen to the economy if we woke up tomorrow and the rates were just at 5% compared to when they've been at 7. You know what I mean? Like, it's just, it would be crazy,
It would be
right?
yeah, just nuts.
Yes.
Bidding wars on
Yep.
everything, not just
Yep.
houses, but literally everything.
Yep. And I just don't think that that's going to happen. So it's going to be slow and steady, Eddie. And if they do fall, it's going to be a very consistent fall. It's going to be okay, here we go. Now we're in the mid 6s. Now we're in the low 6s, and this is going to be over the course of months. in my opinion.
I agree with you there for sure. Could not agree more. So that kind of takes us into our wrap up as a whole and recapping the episode. And I would say, again, I can't emphasize this enough. The answer to our question, to our episode here, should you buy in 2025 or wait? It all comes down to personal circumstances and your own personal situations. Just knowing what's going on, obviously, in the market, in the economy, et cetera, is a very big plus, and obviously information that you need to have in order to make a decision. But ultimately, the decision lies with you in your situation, in the everything that's going on in your life at that time. If you're ready to purchase a home, there is no better time than the present to do so. If you're not ready to purchase a home at this point, it's not likely a good time to do so at this present time, but it's a good time to start putting out a roadmap, putting out a plan on how we can make that happen in the future. And so again, just want to emphasize it one more time. It comes down to your specific situation. Make sure that you're taking that into account when deciding whether or not to purchase your home here in 2025 or not.
Yep, I wholeheartedly agree. Got some people that we know that have purchased this year and it made sense for them. And we have some people that are, still on the fence, kind of waiting it out. And, again, that's what makes sense for them. So ultimately, just wanted to show you guys some numbers, and just kind of take a look at, what can go on in the market when things change. But ultimately, again, like Zach said, it really does boil down to your personal preference, what you feel is right for you, you yourself specifically, your spouse, your family, whatever factors you're, taking into consideration. If you have any of those things, obviously you have to, make the best decision for you. So
And I think that we use some of these numbers, some of these facts in this episode to show people that are ready, that are maybe, being influenced by outside factors or, thoughts in their head, discouraging thoughts, things of that nature that are not doing it if they are ready. And so if you are ready and you're deciding not to because of external factors and things like that, I think that we presented some of the, examples and some of the facts in today's episode to show you what you may miss out on if you decide that you are ready, but you're not going to act on the feelings because of whatever it may be, external factors or thoughts or whatever it may be. And so I think that that was kind of how we wanted to present the episode today, is show the people that are ready what they may miss out on by not allowing that to happen. So
I agree. Yeah. I mean, definitely not trying to, persuade anyone who is on the fence, when it comes to, personal life matters and things that are going on and those sort of things. Just, ultimately just wanted to show the data for people, like you mentioned, that are ready, that have been waiting and will likely tell themselves they're going to continue to wait for this magical time that's going to come, that's not going to come. And just, looking at the raw numbers of it all, what is it, does waiting even make sense? And when you look at, buying now versus buying down the road, again, even if, unless we were to get back to 2 or 3% interest rates, I don't think that you're going to see substantial enough savings when you take into account appreciation if you wait. It's just not going to, you know what I'm saying? And you're missing out on that. So you buy now, you're going to, yeah, maybe make a little bit of a heavier payment, but you're also like in those examples, you're the one house in Columbus, you're going to make potentially, if history serves itself, it went up 4% the last 3 years on average. It could go up another 4% the next 3 years on average. And now you've built $56,000 worth of equity, and all you did was lose out on $79 a month.
yep.
So,
Couldn't
but yeah,
agree more, brother. Couldn't agree more. I think it was a pretty good one for the listeners for sure.
absolutely. Hopefully, helped solve some of those riddles, those equations going on in your head out there if you've been on the fence. And obviously for anybody else who isn't on the fence, and you definitely want to buy down the road, and hopefully you still find this episode valuable, and like Zach said, creating a roadmap and trying to get there. I think getting in as soon as you can ultimately is especially when you're talking about, if we're talking about it as an investment and we're talking about it as the value goes up, the sooner you can own the house, the more, time you're going to have to be in there to let it continue to grow in value.
Absolutely, absolutely. So if you guys have had a situation like this, maybe in 2022 you decided to take the leap of faith and purchase your home, and now in 2025 you're sitting on wads of equity, or maybe on the other side of things that you have decided to wait it out and see what the market does. If you are one of our listeners have been and have gone through that situation, please let us know. Reach out, and we want to hear about it for sure. We just want to hear about your specific situation and kind of how it worked out for you, or and what your thoughts are as a whole. So um, definitely want to hear from you guys.
Absolutely. Absolutely.
Well, appreciate you guys tuning in today, and we will see you guys on the next episode.
All right, y'all. See you guys later.